recording. Clearly respected this bearish order flow in here, right? So we create this hourly SIBI, right? From this hourly SIBI, we go down a lower time frame, right? And then we just look at structure. So the structure then put in is what? Bearish. Do you guys see the market maker sell model then? For news. So I took this trade in the morning. It was a pretty easy trade, I would say. I think I played the second stage distribution, so I didn't take the news entry, which would have been, this market structure shift, and then right here below this low, which would have been this candle right here, and then I think the low risk entry or the most premium entry is going to be this order block, right? I guess you can use the entire wick. Alternatively, you can use this breaker. Those are both premium entries. Whatever entry you want, you could kind of take. Let's say you took the breaker, you'd use that. Let's say you took the order block, you'd use this. There's also what is this right here between these three candles?
Fair value.
Similar.
Oh, that shit. Oh, the order block.
What about this candle body to this wick? What is delivered in this one candle?
To redistribute rebalanced
RDRB?
Yeah, yep, RDRB right in here. So there's 3 different PDAs. Again, we're at the point in the mentorship where I'm not going to be teaching you which PDAs to use. You can use whatever you want. Although today we're going to get into a cool topic, which is PDA selection, which is high confluence PDAs and what to look for in them. But there's an RDRB in here, taps once, distributes once, puts in relative equal lows, right? That's sell side. That's sell side with a double bottom, right? Then 930 gives us a nice volatility injection after sweeping this low, comes back into our premium array, boom. That's why we have to hold for the invalidation of our array, right? The target for this entry isn't going to be this low, although it is 40 points, which is the model. It's obviously going to be this low, right? This is the 5-minute sell model. And then we can also use things like standard deviation projections to frame a symmetric move, right? So we get a reaccumulation right in here, a delivery in here, and another reaccumulation at 10 a.m. during the silver bullet, and then a final delivery. So that was the morning price action. Then in the afternoon is where I personally got chopped up. I was trading ES, but we can look at the NASDAQ chart, same thing. So we came down into this, CE of the daily fair value gap, or just about. Let's look at the hourly chart again, right? Still looking for sells. The reason why I'm still looking for sells is because really this is all butter to me, right? Like this is all incredibly LR. So we were saying all day that until ES really takes out, until ES takes out this, we're not going to be looking really for any sells, right? Or for any buys. This is going to continue to be our butter or our draw on liquidity. Notice how these standard deviation projections played out, again, very, very nicely on the hourly for ES, right? If you take this manipulation leg between 1 and 1.5, we get our retracement back into here. Then we get our delivery all the way to the 4th deviation tick, which is the low of the day. And obviously for the draw, we have our Devil's Mark candle, which we've had, for how many days, which is going to be this true week, or this weekly open from last week, or 2 weeks ago, I guess you could say. And then boom, came into that, filled in that volume imbalance, targeted that candle with no wick, and then closed back in the range. That was yes. And then on NASDAQ, we could see something similar, right, with FOMC. So we came back into this hourly gap. We referred back into it. We also created another gap here. So if we're looking at a 2-stage delivery, right, and we're looking at maybe London to be the protraction for the day, right, we came and we hit that 2nd deviation kind of to the tick here, and then our final target somewhere down here, and then the afternoon reaccumulates. And this is where I got chopped, is because this puts in an SMT with ES like this. So during this, secondary news release at 2:30, we get this massive run up on NASDAQ all the way, taking out all these highs, forming the SMT, and eventually coming all the way back down, right? So That was the price action. FOMC is a bitch. Really, like, navigating this price action is quite difficult because it would have been hard to anticipate this SMT forming, first of all. You would have expected maybe this hourly gap to hold, and just the volatility of these candles is so immense. So it's very, very tough to trade. All of NFP week, especially FOMC days and NFP days are hard to trade. But now that we've done that, let's get into the lesson. Any questions about today's price action? Did anyone find it like a very easy read?
I just wanted to ask if low resistance liquidity takes priority in front of equal highs, as I understand from ES's example.
Yeah, good question. So these equal highs, I really don't like how we left them. And like, if I was a market maker, I wouldn't have left them, right? It wouldn't make sense if we want to go into a higher time frame sell-off like we're framing on the daily chart, right?
Yep.
This doesn't really make sense for me. That's hence why I took a loss yesterday holding to this high, because my mind was resolute that we are going lower. Like, we are going to attack this, and I was like, oh, well, this is butter, right? I was like, this is butter, so we're going to attack this high first. There's no way we'd leave it, right, in a higher time frame sell model. You also remember, this 4957.25 is also this high. Do you see that?
Yep.
So it's not just we put in a double top on the 4 hour. Like, yes, we put in a double top on the 4 hour, which is incredibly shitty. But we also put in a double top now on the daily, which for me made no sense. Because if we want to go lower, why would we put in now a 1, 2, 3, a triple top on the 4 and a double top on the daily? If that's the liquidity purge we want, now we're putting in a series of equal highs that's going to be a magnet for price. Even this 4960.25, it would have made sense to come in and take all this out. But even just taking out this would have been nice. We didn't do that. So, yeah. I would say that LR isn't always a target over double tops and double bottoms. I would say they're both magnets for liquidity. However, once we entered a sell program, right, and you can see where we enter a sell program with this candle. Do you see this candle displacing through these lows and then the next candle gapping down? Effectively, once we close through this fair value gap on the 4 hour, you can see how this is going to be used as now resistance, right?
Yep.
The hourly is even more clear, actually, because that 4 hour fair value gap exists. We also get the massive displacement candle lower, a gap down, and then we come in and we refill this 1 hour all day. Once we break off in the New York AM session, right, this shelf here, this is essentially just an accumulation, right? So now you can start to frame fairly easily your market maker model, right? So this is your original consolidation, A1. This is a small bit of accumulation, really just manipulation, and then boom. And obviously our original consolidation is down here, right? You can see that?
Yep.
So all of this in here is just like nothing. This is nothing. Like, all of this, like, whatever, how many days of price action is absolutely nothing for the price action to go through. That's why when price is here, we were anticipating this move lower. But yeah, I agree. This being left is a mystery to me. I don't necessarily know why. Couldn't tell you. And it wouldn't make sense. If I was engineering perfect market conditions, if I was going to sell off, I wouldn't do that. So maybe we're not going to sell off.
Yeah.
Who knows, right?
Yep.
And then,
But it makes sense to be bullish for next days and for NFP on ES.
it makes sense to be bullish, you say?
Yes, for ES.
Yes, it yes and no. Like, it makes sense to be bullish because we come into a weekly fair value gap on ES, right? So this is our weekly FVG, but what do we need to see out of this to get confirmation of this? A bullish structure.
4 hour bullish structure.
Yeah, and does ES or does NASDAQ look bullish or bearish?
Well, at the moment it's bearish.
Well, if NASDAQ has clear lower and higher time frame draws, right? Like a 4 hour draw down here. ES took its 4 hour draw, right? Like, if we go back to back, right? 4 hour here and the 4 hour here. ES has come down and taken out this 4 hour draw. NASDAQ has taken out this 4 hour draw and then reused this entire area as what? What does this become now? Let me refer back to it. This becomes a breaker, right?
Yep.
And now we've traded away from that. Now, it could just be to come into this weekly fair value gap we have here, right? Weekly fair value gap, daily fair value gap. And it could break structure back to the upside. But there's nothing bullish about this NASDAQ area, which if this is the same draw. Now, ES, as you can see, has a lot of inefficiency in here. So this could hold us up, especially something like this. Like this area in here could definitely hold us up because we have this massive inefficiency. And we also have this breaker, right? So this area in here could keep us up. Same with NASDAQ, right? You'll see on the daily chart, we're coming into this daily kind of breaker right here and daily fair value gap. But I'm not going to be bullish until I see structure coming out of here, at least on the hourly. I'm just going to treat this like you can look at the hourly or 4 hour because we're in a weekly and a daily fair value gap, right? So all I see right now on both of the indices is like this massive inefficiency that if we can somehow manage to trade above this high, then yeah, maybe we can look for higher prices. But I mean, getting above this high is going to require quite a bit of work. I'm not going to take the intermediate structure in here, right? Say we put in another high, like a lower high, and then we do this. For me, really to be bullish, we have to close above this high because this is the manipulated high of this run, right? In terms of structure. The rest is intermediate highs. See that? So this is our dealing range. I'm not convinced on higher prices until I see this high get closed. And then the draw is not like, I mean, then yeah, then sure. If we close all the way above there, it's only 25 more points. We have to now make up a distance of like 50 points, which is essentially this 1 day worth of sell-off. Now, it could happen. And it's completely valid, by the way, to take an intermediate term high. I just have to do some damage control on my account, right? And not take this structural break right here, but instead wait for this one. Because I've taken two big losses and two big losing days. Despite, I think, knowing where price wants to go, just not the best entries for myself. But yeah, we'll see what happens out of this area here. We'll see if we can get some movement higher. If not, I still favor, this 20-day low and this low-hanging sell side. Right, so this 20-day low aligns with our daily ERL right here. Oh no, this is our original consolidation. This is our IPA 20-day, and it lines up really nicely with our daily market maker sell model. Because now for me, I can just see monthly level and then daily market structure shift. If anything, we're gonna try and retrace this, right? This volume imbalance. Now that could be
that could be the 49.60 for ES too, right?
Yeah.
Like if we retrace that.
Yep. So this could be the bullish move we want to come fill in, right here. This would be our daily VI. But other than that, I don't really see any targets to go to long to. So yeah, sure, we can come in and rebalance the daily, but we've already rebalanced the hourly gap. We've already rebalanced the 4-hour gap in here. So I don't know if necessarily we need to come in and fill the daily. We might, and it would make sense. And then on ES, right, it doesn't have anywhere near as much of that daily gap to fill in. I mean, that daily gap's up here. Let's see. Yeah, I guess. You guys think ES could reach for this daily gap? All the way up here?
Daily gap?
Volume imbalance right here. Yeah.
That's far as shit.
Well, if it does, then it should just take out this high, right?
Yeah, I mean, that's really far for ES, that's pretty far.
Yeah. Yeah, for NASDAQ, there's lower structure, right? And that also aligns with this breaker right here. So yeah, maybe we'll see something like this. Could also just see this. Don't really know. It could go either way, right? Could just keep going down. I have no clue. I honestly have, it's impossible to know right now based on structure because there is no lower time frame structural confirmation. The sells really hit today. Like if you were playing sells, you timed your sells properly, you got the butter on ES. This is like exactly what every single MMX trader is a wet dream for, right? Like this looks like LR to the max, doesn't it?
Yeah.
Right? This is like butter. Like this is exactly what you want to see in terms of a sell-off. Now in here, we could just reaccumulate. We could do some choppiness. We have NFP. We could come lower. I don't fucking know what's going to happen. I'm probably not going to trade this week just because I'm doing damage control. So I'm trying to only take high-quality setups. I'll look for maybe something like crude. Which again, Yusuf, you take that crude trade today?
Yeah, I did, and then I got fucked the second time. But
Yeah,
I printed it
exact.
in the morning, and then I
Yeah,
got fucked the second
it
time.
printed a really nice setup again, and then I just like look at the 4 hour on crude.
You see that wick in the
It
hourly
looks
that was
so
there?
bullish. Like even the daily looks so bullish.
Yeah.
But can't time the market, so we wanted to come back down, take out all the sell side again, and now I don't know if we checked this out yet. We did, yeah. Now okay, now maybe it wants to go. So again, same thesis I'll be using for crude, right? If we can close above this high, probably I'll consider that a market restriction because that was the last manipulated high before we took out all of this liquidity. Right down here is our liquidity sweep. So I'll maybe look to trade crude. Just yeah, on the indices right now, I'm not entirely directionally sure about where we're going. But let's get into the lesson. That was just a nice little quick market recap. Let's get into the lesson. Make a copy of this. Okay, now this is a lesson that I've been thinking about for a while. I don't really have a planned like curriculum per se for this lesson, but it's going to be about selecting the correct PD arrays and kind of looking at what secrets we can use to make sure that the PD array selection we have is the best. So let's talk about a couple of them. Let's start with the most common PD arrays, which are going to be fair value gaps. Turn the background on and turn the border on so we can see it and make this a bit bigger. So let's frame what constitutes a plus fair value gap. When do we expect FVGs to be breakaway gaps, we'll say. And then when do we expect to see FVGs invert? And that's any other concepts I want to cover in fair value gaps besides these three big ones. Any questions anyone has about fair value gaps? They're like one of the most basic PD arrays, but they're like a lot to them. If not, then I'll go with these three because these are probably the three things that I want you guys to know the most. Okay, let's talk about these three things. So what constitutes an A plus fair value gap? When do we expect fair value gaps to be breakaway gaps? And when do we expect to see FVGs invert? So a fair value gap is the result of institutional displacement. We can clearly, like, if we just look at structure, right? Fair value gaps form from displacement legs. They also form as a result of usually liquidity being taken. So everyone knows they're a 3-candle pattern. It looks like this, and the common way the market moves is from external ranges back into internal ranges, where the internal range is going to be our fair value gap. So that's the basic theory behind a fair value gap in terms of the 3-candle pattern. Now let's talk about what causes A plus fair value gaps. An A plus fair value gap will always be followed by some form. Let's look at a lower time frame chart, for example. Maybe let's use the 4 hour for this analysis. By some form of liquidity sweep. So let me turn off the markers. All right, will always be after some sort of liquidity sweep or turtle soup. Meaning, you guys have probably seen this before, but there's 3 entries usually that ICT frames for a solid buy. And these are the 3 entries. So you see how liquidity's been taken below this low?
Yep.
Okay. So this liquidity sweep here is also engaging what?
Fair value gap.
You see how this fair value gap quote unquote fails? Meaning we close through it?
Yeah.
So the reason why this fair value gap quote unquote fails, which is a common question, like, okay, obviously the narrative is still higher, but this fair value gap fails, is simply because this fair value gap has now what rests above all of this fair value gap? Like, what would we call all of this? For the most part. Right? Yeah. We've induced, like, even this wick into here, right? That we got. at 10 a.m. on Thursday, followed by this choppiness, right? That liquidated most of this liquidity in here, right? However, did price actually push up meaningfully from here?
No.
Okay, meaning this fair value gap has been utilized with no displacement to the upside, right?
Correct.
Okay, that should be a red flag in and of itself. So that's another conversation. Let's talk about that. When a fair value gap fails to produce a meaningful break of structure after, that fair value gap's reaction should fundamentally be considered to be like not A plus. What you want to see is an immediate reaction from a fair value gap with higher prices, i.e. you want to see an internal range cause an external range to be formed. So if you don't form a new external range off this fair value gap, then immediately you want to start saying that's not an A plus FVG and price could tend back lower. The same reason here, you'll see. Do you see how this fair value gap fails in here? This 4-hour gap, right?
Yeah.
But this next candle. Now, why do you think that might be?
It gets close through.
Yeah, of course. Yeah, it does get close
Yeah.
through. That's when it quote unquote fails, right?
Yeah,
But why do you think that this long wick, which swept this liquidity, was not enough, based on what we just said, that first concept?
There's still liquidity before it. There's still too much
Actually,
stops. So
it takes out this one candle takes out most of the liquidity, right? Takes out this swing high on the 4-hour. But why do you think this can't? What immediately, right, is going to cause you to question this fair value gap when we see this next candle open? What do we? Same argument as this one right here. What do we not do after tagging that fair value gap?
Oh, displace down.
Do you see how? And let's go to lower time frame. Do you see how we are failing to displace from this fair value gap? Even the 15-minute chart. We're coming into a 4-hour fair value gap. But do you see how we're failing to displace it? Even here? We're just chopping in it. This immediately is going to give you an indication that fair value gap is not an A plus fair value gap. Compare that fair value gap, right, with this one. What's happening in this fair value gap? The minute we tag it.
Displacement.
You can obviously see in hindsight, but let's look at a lower time from like the hourly chart, right? Do you see the difference?
Yeah.
Essentially, the candle after we tag it, we get a break of structure to the downside, right?
Yeah.
Let's look at a 15-minute chart. That's what you want to see. Do you notice how we're forming exactly what model do we trade?
Well, market maker.
Do you notice how we're forming that immediate market maker sell model out of that higher time frame inefficiency? Right?
Yeah.
4-hour gap leads to a what time frame market maker model?
15.
Okay, so you can see that we're immediately reacting and getting that market structure shift, framing this low as the draw on liquidity, right?
Yeah.
And we're doing that within within an hour. So within an hour of interacting with this 4-hour gap, we've already broken structure downside to the downside, right? Now the rest of this, we can just look for sells. And even here is the perfect entry on the 15 because we have, this low-hanging fruit, the higher time frame, and boom, we get these massive candles. So what we want to look for, our first takeaway for fair value gaps is that A plus fair value gap will produce a lower time frame displacement move rapidly. We want to see institutional sponsorship of that gap immediately. If we don't, we're not going to call that an A plus FVG. So let's put that as a note. So you want to see institutional sponsorship, i.e., wow, I can't type, displacement. If we don't see that displacement, immediately red flags go off in our mind. An A plus fair value gap will also generally be produced after a liquidity sweep. So, do you notice how this fair value gap in here is simply an internal range, right?
Yeah.
Does the candle before it, preceding it, produce a liquidity sweep?
Candle before does it produce it? No.
Does the price action before it produce a liquidity sweep? Even the subsequent 5 candles.
No.
Right? High, low, high. This is a failure swing, right? Of these highs. So there hasn't been a meaningful liquidity sweep on this time frame, has there?
No.
Now I juxtapose that and compare that with this. This high being rated into this displacement. Now this fair value gap. Has this fair value gap produced a meaningful liquidity sweep before it was created?
Yes.
Yeah.
Yes.
So price has no reason to return back above this high, does it? This is your
Correct.
HRLR signature. So if you're looking at entry models, right, there's 3 always. The first entry model will always be a turtle soup or a liquidity sweep, whatever you want to call it. Then, if you studied ICT content, you'll know there's 2 more. What's the second one? Fair value gap, right? So turtle soup is 1. And then you'll see 2 is going to be your FVG. In this case, it's a sell side imbalance, buy side inefficiency. And then 3 is going to be what? Your breaker. Right? All 3 of those are valid entries, correct? Or you can call it the order block. In this case, the order block and the breaker are the same level. But these are 3 institutional levels where you can get short. Turtle soup, i.e. liquidity sweep. Fair value gap, ERL, market structure. Remember, market structure shift here. ERL to IRL. And then the breaker, right? This would be called a unicorn setup, but there are 3 individual setups you can take. This breaker, this SIBI, this turtle soup. Now, with respect to the fair value gap, based on that conversation we just had, we can add 2 points here. So what constitutes an A+ fair value gap? Institutional sponsorship. We want to see displacement. What else is going to make our fair value gap stronger based on that conversation we just had right here? There's 2 things.
Take liquidity.
Yep. Sweeps liquidity beforehand. Now let's use some real SMC language. What does the liquidity sweep result in above that fair value gap? Why doesn't price need to go back there? Thinking of types of liquidity.
External.
Close?
Take
With external, so then it needs to go to internal.
Don't think of ERL and IRL. Think of forms of liquidity, like low or high resistance.
Oh,
What is
generated high resistance liquidity.
Yeah. So let's. This directly generates HRLR conditions against the FVG. Does that everyone understand that statement? In the direction against the FVG, we have directly generated HRLR. Make sense?
Correct.
Right? HRLR is right in there, whereas to the sell side in this case we have LRLR, right? Like that. So this generates that HRLR condition, which is good because it protects price from wanting to come back in to that fair value gap. Fantastic. What's the other thing I just mentioned here that we have?
Order block, or I guess it's breaker also.
Yeah. Is paired with a breaker / OB. So you're going to find that lots of times, right, fair value gaps don't have breakers and order blocks attached to them. Let's look at for examples of that. Here's an example of a fair value gap that has a breaker attached to it, right? Right there. No order block. Still a good fair value gap. What about this one right here? Is there any breaker or order block in here?
No.
What about
No.
this one?
No.
No. So in my mind,
No.
these are still valid fair value gaps, right? But they don't have an associated structure of an order block or a breaker for me to give them an A+ rating. What would be better would be this fair value gap down here. Why do I like this fair value gap more? What does it have?
Order block.
Yeah, it has a down close candle, right?
Yep.
Right, so that's another thing you can look for when you're qualifying an A plus fair value gap. Is it paired with a breaker or OB? In this case, this fair value gap gets the job done. But you see how we have to accumulate in it? It's not a violent reaction from that fair value gap. This is also because of the time. It was under age. This is actually no. This is a Monday, I guess. But you'll start to notice that the most violent reactions from fair value gaps often come when they're paired with something. So let's take a look at example for today. Look at this fair value gap in here. What do you see is paired with this fair value gap?
Breaker.
Yeah, right?
Yeah.
It's fantastic. You also have this lower breaker. Right?
Invalidation would be the upper breaker, or would it be the fair value gap?
Fair value gap, right? This high.
Fair value. Okay.
Now this is going to lead us into the next conversation, which is when do we expect FVGs to be breakaway gaps? Why do you think that this fair value gap, even though it's more in discount, doesn't get filled in?
It's a premium. Oh no. Well,
Yeah, if it's premium, you'd want it to get filled in, right?
it's premium if you
Breaker.
Yeah.
Yeah, so we can start actually looking at when we expect fair value gaps to be breakaway gaps. So one reason is that there is high confluence structure above or below it. What do I mean by high confluence? I dot E, there is a breaker plus FVG. New structure in the form of an order block. Right? Or more fair value gaps. You've heard me say before, we risk the lower one, right? And we have to accept that it could come into the higher one.
Yeah.
That's because when we form new structure, specifically new breaks of structure, so we get breakers and we get order blocks, right? Like up close candles in bearish moves, down close candles in bullish moves, and then we get down close candles that we close through in bearish moves, right? On the other side of the curve. Those are now new structural resistance, right? So these areas here can actually act as a breakaway gap. Make sense? Because there's a level of structure that it doesn't need, that it's engaging with below that price action. So this in here doesn't need to be engaged. Why? Because we have, right, an array which is stacked here of a fair value gap, this breaker and this breaker, right? Price doesn't necessarily, and look, also we have this order block, these sets of up close candles, which you notice how price doesn't close above. Do you see that?
Yep.
Yeah.
So there's 1, 2, 3 PD arrays. When there's 3 PD arrays, you have to risk the lower or the higher and accept that the lower might be all it trades into. Now that's a really easy response. That can be pretty cherry picked. Like, well, you can obviously see that if he's, of course, in this case, there was more structure above, below, so that's why it was a breakaway. So what else can we do to frame breakaway gaps? Well, they are a part of a balanced price range. Now, you probably didn't notice that when I first said it, but what do you see right here? Do you see the 2 fair value gaps on either side?
Yeah.
Yep.
Right? Here is your buy side imbalance, sell side inefficiency. Here is your sell side imbalance, buy side inefficiency. So these overlap like so. This one and this one. Now, if we consider, again, what is inefficiently delivered to the buy in a bullish fair value gap?
Sell side.
Buy side, right? Is inefficiently delivered?
Yeah.
No, buy side is delivered normally.
I
but
thought
sell
buy-
side-
Yeah,
thought
it's
you said it-
but you're right. Sell side is delivered inefficiently, right? So we have to reprice that, correct?
Oh, okay.
And then Niku's right. And then what about sell side imbalance? What's the state of delivery in this candle only, Niku?
Sell side only.
Yeah. So we're only pricing buys here. Let's give that a value of like, let's give that a positive, okay? Then in this candle, we're only pricing sells, which is a negative, right? The reason why it's a balanced price range is because the sum of this price action and this price action is going to be net balanced. right? There's only been buys distributed through this area of price in time, right? Time and price. And there's only been sells distributed through this area in time and price. So net, in this entire region of time and price, there's been a balance of price, both buys and sells. So a balanced price range can often be a breakaway gap. That's also known as a sharp turn or V-shaped recovery. Will look like something like this often on your charts. All right. Let's see if we can prove that statement in more cases than just one. Here's a breakaway gap, but that's not for the same reason. Okay. No, unfortunately,
There's a
we
small
repriced
one.
this wick. I was gonna say this area in here would be a really nice area because we have, yeah, right there. You see that? I have a balanced price range right here.
Yeah.
And then above it, what else do we have? Based on our first rule. What do we form above that BPR?
Breakaway gap.
Yeah, well, this is a breakaway gap in here, but what do we have?
I mean, that's the breakaway gap.
Yeah, we have
fair
two
value
more
gap that
fair
we turned
value
into.
gaps, right? We have
Yeah.
this, and we also have this. Notice how price is contained by both, by the bodies? This 4 hour and this 4 hour? So we have higher structure, which is our first criteria. Remember we said there's high confluence structure above, and they're a part of a balanced price range, okay? So this is part of a balanced price range, and is there high confluence structure above? What do you see right here? What's this?
That's a breaker.
Yeah, it's a mitigation, right?
Well, yeah, mitigation. Yeah.
Yeah. So we have a mitigation block, a fair value gap, a fair value gap, and we have an RDRB. Right? It's also a fair value gap in here. Oops. So we have a lot of high confluence structure above this high, or above this fair value gap, don't we? We don't need to revisit this, and it's part of a BPR. Okay, cool. So those are two criteria.
Is that still a valid trade though? Because we didn't have a market structure shift after we traded that, right? Like we're still.
So in these types of recoveries, V-shaped recoveries, you can often use fair value gaps in lieu of a market structure shift. You'll see it all the time. It's like an early signal of market structure shift is using a fair value gap, right? So
Yeah,
for example,
I know what you're talking about.
For example,
yeah, I just wanted to
we have an SMT formed here, right? And this SMT leads to this fair value gap in here, which is a part of a breakaway gap again, which we'll notice that doesn't get visited until later on. However, once we invalidate this fair value gap right here, right? Do you notice that this becomes an inverse?
Yeah.
You can use inverse fair value gaps inversions before market structure shifts. I did an example on NQ on the 1 minute, I believe, sometime today or yesterday. I saw a 1 minute. Oh yeah, this is an example this morning. Did we see this inversion on NASDAQ on the 15?
Yeah.
Yeah, and eventually price delivered, all the way down to sell side, right? Using that inversion in there. I deleted it off my chart because I was using the 5 minute gap instead, but inversion gaps can be used sometimes in lieu of a market structure shift. Or just new fair value gaps. That's an early indication of like displacement, right? Which is going to be that institutional sponsorship. So when we're seeing displacement, then we can say, okay, well, we're likely to get a market structure shift. Okay, so that's two reasons we might see breakaway gaps. Here's a third reason, and this is going to do it with candle structure. If the third candle in the sequence of a fair value gap closes above the high of the second candle, we can anticipate a breakaway gap. Hold on, what did you just say to me, Hafiz? If the third candle in a sequence of an FVG closes above the high of a second candle, we can expect to see a breakaway gap. Let's see if that's cap or that's a true statement. Here is a 3 candle pattern in here, okay? 1, 2, 3. You guys see that? Let me just do this.
Yeah.
Wait, why is that the first candle?
I'm gonna draw it up.
Why is
I think
it-
he's framing the middle FVG. I think that word
Alright.
number is the FVG. I think. I'm not sure.
Oh, whoops, you're right. It should be this one.
Oh, is that okay?
Yep, my bad. I'm not framing that middle FVG. Okay, you see how this this third candle displaces the high of this second candle?
Yep.
Okay, we can anticipate that because it displaces the high of that second candle, this may be a breakaway gap. Now, let's compare that with, whoops, this. So this is a breakaway gap, we'll call it condition. Because this third candle right here displaces this high. Now let's rejig these, put this third one there, put this second one there, and put this first one here. This is what I wanted to show. Okay. Does the third candle, in this case, let's see, 1, 2, 3. Oh wait, I'm trying to do this one, I think. Yeah, there you go. Does this third candle close above this high of the second candle?
The third candle does.
No.
No, it doesn't, right?
Oh wait, which one? Wait, which one's the third one?
This little doji.
The small one. Yeah.
Oh, the tiny little doji.
Yeah.
Yeah, then no.
So because this has left this now the reason why I'm saying this isn't random. Think about what you're leaving here in this third candle. What are you leaving now here?
Stops.
External ranges, right? So internal to external. See how it makes sense to come internal now because you've now manufactured an internal high? Or you've generated an internal high? Now compare that, right, with this. You have this one, and this one. Is there an internal high that's been left anywhere in this 3 candle pattern? No, right? This third candle closes well above this second candle, doesn't it? Now the internal high is here, right?
Yeah.
So why would it come back into? Well, it can, obviously. But is there more or less of a reason for it to come back into here than in the case of this 3 candles, 1, 2, 3, where you've left this external high?
No, it does. I guess it doesn't really have like a reason to.
Right? In this case, you can see we're displacing through, right? So let's take a look at this fair value gap in here as well. There's 3 fair value gaps. So in this case, we have 3 candles that form this fair value gap. 1, 2, 3, right? Now the reason why I think we come back into this fair value gap is because we form another fair value gap here. Do you see that?
Yes.
And now, despite this candle closing through this candle, we've now generated this external high with another fair value gap, right? So we close through this, we come back into the discount of the range, then we move higher. But this lower fair value gap down here, you can see, because it's following and I'm not saying use this in isolation. I'm saying use this with the rest of these conditions, right? Remember, high confluence structure, BPRs, and this third candle condition. So you can see in here, we have we have 2 of those 3 things met, right? We have high confluence structure above, more fair value gaps and a breaker. And then we also have that this third candle right here, right, is displacing the high of this second candle. So now you get 2 of these conditions. Does that make sense?
Yeah.
Okay. All I'm trying to do is give you some indications early before you see breakaway gaps that they might form. So that's one. Let's see if we can find some more examples using these 3 kind of rules to try and frame our breakaway gaps, because we'll find more of them. So first of all, let's locate a breakaway gap.
I see one. Yep.
Okay.
Yeah.
Oh, also, of course, there's one more thing we have to add, which is pretty rudimentary at this point. You'll definitely know what I'm going to say. There is right? That one makes sense?
Yeah.
There's an SMT. Obviously, in this case, there could very easily be an SMT at this gap. Let's see the ES charts. Oh, no. ES also leaves it as a breakaway. Cool. Let's see if we can analyze why this might be a breakaway gap. So let's look at our conditions. First of all, what can you immediately see here? Your eye should go to it immediately. Which condition is being met here?
It's rebalanced.
Yeah, balanced price range, right? Everyone see that?
Yeah.
I'm only hearing two voices. I need to hear everyone say, ah, yes. Mitch, Jimmy, Niku, MJ, Gomez. Do you guys all see this as part of a BPR? Before I start busting out the soundboard myself and I say, horseshit! I don't teach these lessons for two people to be active. Let's all weigh in. Do we all see this BPR here, right?
Yeah.
Fantastic. One condition is met. Let's see if we can find more conditions. Remember, I'm not like a wizard, guys. Like, I'm just trying to give you early indications of how things form based on my experience. By the way, ICT really hasn't taught these things. This is just from me staring at fair value gaps for hours and hours. So, again, take everything I'm saying with a grain of salt, back test it yourself, and trust me that some of this stuff is actually true, and I've found it before, and I'm sharing that with you. So it's part of a BPR. Fantastic. Condition 1 met. So let's call that. We'll call this condition 1, BPR. We'll put that on the right so everyone can see it. Okay, let's look for what other conditions can be met. Is there other high confluence structure above this gap? Yes or no?
Yes, we have that breaker.
Yeah, there's a breaker there.
1 breaker, 2 breaker, 3 breaker. See that? I'll draw them all out.
Yep.
1 breaker, 2 breaker. That's the same area. It's fine. 1 breaker, 2 breaker, okay? This is real structure. We cannot fade this structure because price doesn't need to reach into this gap if it is reacting off of this breaker. That's all it requires is that breaker. Look how it fulfills this breaker, right? Yeah, you don't fade structure. We never fade structure. We react to what structure is coming, and then we predict which will form out of it. So we have this breaker in here, this breaker in here, and this breaker in here. That's condition 2. So let me label it. Condition 2, high confluence structure. Fantastic. Okay, what about the third condition?
Yeah, the third candle closes above that second one.
1, 2, 3. Do we displace through the second candle?
Yeah.
Okay. So there you go. This is our third condition. Yeah, I'll take a picture of this, throw it in the education channel so we can refer back to it later. Let's put this under this. Let's go breakaway gap grid confluences. Okay, cool. Let's see if we can find more. Again, it's just about reinforcing these concepts in your head until you can start seeing them. So let's find another breakaway gap. You guys see this one? Yes? Yes, no, or the breakaway gap invisible to some of us? Yes.
Yes.
Breakaway gap. Okay, cool. Who wants to do the analysis of the conditions? Yusuf, you do it. Start with condition 1.
All right, cool.
Is there high?
All right, so the first condition is high confluence structure. Can we look left for this or no? Like we can't go that far back.
Of course, you have to look left. Yeah, absolutely. In this case, looking left's not going to help.
There's nothing there.
All-time highs.
Yeah, nothing there.
I mean,
this is all-time highs. Okay, yeah. So the first condition isn't that.
That's a lie.
So,
you can look left, but you have to look very, very far left.
You gotta go really, really far.
Yeah, let's not do that. Let's just look immediately.
I'm pretty sure there's a daily breaker there. By the way, I remember charting this.
Maybe.
I don't think you can use that, but all right, I'll just say the first condition isn't that.
You absolutely can. 4-hour and daily are still aligned. Yeah, absolutely.
Okay, yeah, I remember there being a breaker there, so I'll say that it is met.
Fuck it. Let's just prove that.
It was a long time ago. It was like a daily breaker, and then there was also like an hourly one there.
Yeah, I see this area. Yeah. I don't know if we close above that. I don't know if it's a breaker yet. I think it's an order block.
I think maybe we closed above the after.
Yeah, it's an order block at the moment.
Oh, okay. All right, so then no.
Let's just look immediately to the left.
Okay, then immediately to the left, then I'd say so. The first one is no. So then I would say that it's not like immediately. It's not an A+ breakaway.
Wait, there's no higher structure above it.
Yeah.
Really? What about this? And this?
Oh, those. I mean, okay, yeah, I guess. Okay, yeah.
Well, it's up to you. You're the one analyzing it. I'm just pointing stuff out.
Yeah, no, I was gonna say like if it was with hindsight, you could say that, but I was gonna say like if like in real time I saw that,
Yes,
like I
yes.
wouldn't like know right away
Well,
until I saw
it's
those other
always
two
gonna
fair
have to
value
be in a
gaps.
bit of
So
hindsight, right? Because you're gonna be anticipating ranges, right? So you have a dealing range now, and you're gonna be anticipating whether this dealing range will be rebalanced, right? So you'll always
okay,
have to look
yeah,
for at least one more candle, right, to qualify a breakaway
yeah.
gap, right? But you can see that next candle
Okay.
forms another what?
Another fair value gap. So there is higher confluence structure above. There's new FEG.
So let's write that down right in here. We'll put it again. And actually, there's
You
two
have
F.
new fair value
Yeah,
gaps.
there's two fair value gaps, right?
Yeah. Yep.
Okay, so we'll put this as condition 1. We'll make these fair value gaps a different color, so in our notes we have just the one breakaway gap. Okay, that's our condition 1. Niku, you're gonna do condition 2.
Yes, so condition 2 is if it's part of a breakaway gap.
A balance price
Can
range.
we... yes, sorry, balance price range. Can we scroll to the left?
Yep.
But I'm not sure if...
Let's go all the way to the left and see. Would you look at that?
Yeah, it's part of a breakaway
It's
balance
almost
price
like I'm
range.
not capping. There's no way I
Hafiz,
could.
what'd you hit on your keypad? Sorry, this is a little. What'd you hit on your keypad to scroll left that fast without like moving where
I'm
price
using
was?
my trackpad.
Are you just track padding it? Okay, I get it.
Ah, you see, it's like I'm not capping, eh, Yusuf? It's like this is real stuff I've noticed. There's
No,
no. By the way, there's no
it's
way I
real.
could have. There's no way I could have known there was a fair value gap here, right? Surely I couldn't have like
Yeah.
gone back and like known that, right? So there is
Yeah,
some
yeah.
internal consist. You're not. I've actually a mastermind. I planned this all out. I planned to ask Niku that question about this fair value gap. Again, there's some internal consistency here, isn't there? Wow, look at that.
Yeah.
Right? I mean, none of us knew there was. None of us here knew there was a fair value gap on the other side of the curve there, because that happened, 7 months ago, right?
Yeah.
But look how perfectly it lines up. What does that become? A BPR. So,
BPR, yeah.
so again, there is some real level of internal consistency here that I can't make up. I can't lie to you about that. So there you go. Balanced price range. Is that condition met?
Yep.
Yes, it is.
Cool. All right. Now, who else has been super quiet? Okay, can I spell? Okay, condition 2, condition 1. This is our breakaway gap. All right, what is condition 3? Who's in the call? Gomez. Condition 3.
I can read it, but I did come in late.
Okay.
So, if the third candle in the sequence of a fair value gap closes above the high of the second candle.
That's a pretty easy one for you to do. I'm gonna give you the 3 candles. Okay? 1,
Okay.
2, 3. You tell me if that's true. This is the high
yeah.
of the second candle.
And it closes above the high, yes.
There you go. There we go, guys. All 3 conditions met. Do we have a strong candidate for a breakaway gap?
Yes.
There we go. Now let's check the last condition, condition 4. Is there going to be an SMT between ES and NASDAQ at the gap?
We will see.
No. Breakaway gap on both.
Not really.
Yeah, breakaway gap on both,
Yeah.
right? Fantastic. There you go. We have all of our conditions met. Again, gonna put this in our education tab. I'll eventually transfer this over to the education tab for this lecture, but for now I'll put it in here. Okay, let's do one more, because the more times we do it, the more we'll see it, and then the more times, then we can get into the next thing, which is gonna be, you know what? Maybe we'll just focus on fair value gaps today, and we can do another lesson for the other ones, because there's those tricks like this to every single PD array, believe it or not. And some of them I use more regularly, and some of them I don't. Definitely use these FVG ones all the time. Okay, let's find another breakaway gap. Let's go back to something we don't remember. Okay. What about this one right here? and this one right here. Let's use these two. Okay. These two breakaway
Oh.
gaps. Let's see if we can frame our conditions around them. Again, I'm gonna take a picture of these conditions as well and put them in the chat. Okay. So condition 1 is gonna be is there higher structure? Let's look at the lower one. Is there higher
Yes,
structure?
there is.
Is there higher time frame structure that forms? Again, we can't anticipate that right away, right? We have to wait for structure to be put in. So now, once we see structure be put in, does condition 1 get met?
Yep.
Yeah.
Right.
Yes.
This is the condition. This is condition 1 for the lower fair value gap. This is condition 1. All right, let's just focus on this one. Is this part of a balanced price range?
Wait, sorry, I'm so sorry. You said the second candle was the condition 1. Why isn't it that candle right after it?
No, condition 1 is gonna be is there higher structure?
Yeah, higher structure. You pointed to that second candle, that one. Why
This
isn't
one.
it that smaller one?
What do you mean? What is it?
Like, can you just put where you put condition 1? Mark it again one more
Yeah.
time, or just put your mouse over it, like whatever.
Yeah. So this is the condition 1. Let me draw it out again. This is the condition 1 for the first breakaway
Yeah.
gap.
Why isn't it for the first breakaway? Why isn't that candle before it? Right? Is that not the next candle close? Like you can see that,
Here?
or do you have to wait one more because then the next candle could
what's-
trade back
what's
into?
the
Is that why you
condition?
wait for the
It's
second
higher.
one?
The condition is gonna be like more PD arrays, right, above it or below it.
Okay,
next
more
candle is
PDAs
a
above or
PDA,
below
right?
it. Okay.
Yeah, remember, more structure, right? Essentially, more structure. Structure means PD arrays, right?
Yeah.
Or market structure, like an order block or a breaker are gonna be given to you when you have structure, right? So
Yeah,
in this
correct.
case, this one candle isn't a condition, is it?
No.
Not condition 1. This is condition 1. But you're right on the right track. What is this candle a condition for? As part of our 3 candles? Remember, does
1,
the
2, 3.
high
Yeah, it is,
of
yeah.
the third close above the second? Does the third candle close above the second high?
Yeah.
Okay, so what did you just recognize? What condition is that?
That's the third condition.
Yes. What about condition 2? Is this part of a BPR, guys?
Yes, it is.
Yeah, extend this left. You're going to see that's part of this RDRB, right?
Yep.
Right? This is an RDRB, but also extend it left. Do you see how it interacts with this area of price? This is a reclaimed order block. Have you guys learned that? Yeah, this is a breaker, right?
So.
This is a breaker,
Yeah.
right?
Yeah.
We're reclaiming this order block, which you'll see is what is going to eventually lead to the second breakaway gap, but we're getting too far ahead of ourselves. So let's just talk about how this meets condition 1 as condition 2 as well, right? Is going to be this RDRB. It's a part of this RDRB in here, right?
Yeah.
Okay, fantastic. So those are 3 conditions met for that one. Any questions? Make sense?
Yep.
Okay, that's the first gap. That's why it's a breakaway. What about this second breakaway gap we see? First of all,
It has all 3 conditions, that
Right.
one as
higher
well.
time frame fair value gap right above it.
Yeah.
I'm not going to draw out all the conditions out. I'm just going to do it live. Is it part of a BPR?
Yep.
Right in here.
Yeah. Yeah, that one
Condition
is.
2. Third candle. 1, 2, 3. Yep.
Close
All
above it.
conditions
Yep.
met. Is there an SMT? Alright, someone check. I don't want to go into my ES chart.
When was this? November?
This was November 2nd, 2 a.m. 4 a.m. candle. Or 4-hour candle, 2 a.m. Thursday, November 2nd, 2023.
All right, I'm looking right now. Thursday, November 2nd. Thursday.
2 a.m.
There was. You said 2 a.m. or 2
Yep,
p.m.?
2 a.m.
2 a.m.
Does that come into the lower for value yet? On yes?
Wait, November 2022 or 20? No, it does.
Okay, that's fine.
Yeah, it does. It does.
It does. Alright.
Oh, no. It does eventually trade into it, but I mean, it trades into the first one, then failure swings, then trades into
That's
the
still
lower
fine.
one.
That's still fine. Remember,
Okay.
this is fractal, right? So it did this. What you're saying, it did this.
Yeah.
Yeah, that's still fine. That still frames as a breakaway gap, right?
Yeah.
Fantastic. So I have all 4 conditions met here. Okay. There you go.
Mm.
Now we're starting to see this. Let's do one more example. What about this one right here? Who hasn't talked at all? Because Yusuf and Niku are teaching the lesson at this point.
I know MJ.
I
I
don't know
don't know
if
if he's
Jimmy's-
back
Jimmy,
yet.
are you
I think
here?
He said he was getting.
Yeah.
Oh, he's here. He's here.
Jimmy, you here?
Yeah, I'm here.
Okay, fantastic. You're gonna walk through these conditions with me. The
Okay,
first condition of
let's
this gap is this gap part of a balanced price range? Meaning if I extend this out left, do you see any fair value gaps on this side of the curve?
I would say yes.
Yeah, there's a tiny one in here, right?
That very small one right there. Yeah.
Tiny, but still a fair value gap, right?
That's correct.
3 points, but still a fair value gap, right? Everyone agree?
Yep.
It's not a great condition to be met. But it's still a condition. What's probably the better thing that we're seeing on this side of the curve? Niku?
Part of a breaker.
It's part of a breaker, right? So as you can see, we're pairing it up with this breaker right here. This is going to be condition 2, which is higher time frame structure. Where else is condition 2 going to be? Well, it's also going to be right in here.
Another fair value gap.
Another fair value gap.
Very
Right?
bad.
And we're also producing not just the fair value gap, but we're also now creating this breaker. Right? As you can see, we immediately rebalance what? Do you see this immediate rebalance?
Of a breaker.
Yeah. So that's the breaker.
And it forms on ES too.
Yeah. So there you go. We have a breaker for condition 2. So we have lots of condition 2s being met. Higher time frame structure, higher time frame structure, higher time frame structure. This is pairing up with this breaker right here. Everything's fantastic for this to be a breakaway gap. Okay.
Yeah, also a third candle closes above.
And
So
there you go.
we have all conditions for this
2,
one.
3 conditions, breakaway gap met. So now we can start to expect breakaway. Now let's look at something which is going to be when we don't have that condition holding. So let's look at this. This gap here could be a breakaway gap, and we could expect that. Let's see if we get all the conditions met, and then let's look at the null case. So we're expecting this to be a breakaway gap. Do we get a higher time frame structure? Yes, we do. We get this fair value gap. So that's condition 1. Is this part of a balanced price range? No, right? Is there any inefficiencies in here?
No.
No. So that's not, condition 2 is not met. So we have one condition met, which is higher time frame structure. Now condition 3 is what? Third candle, right? 1, 2, 3. We get the third candle. So condition 1 and 3 are met, and condition 2 is not, still comes back in. Now that's not to say that every time you get all your 3 conditions, you're going to get a breakaway gap. It's just helping you frame them. So this would be the example of a null case, right? Conditions 1 and 2 are 3 met, and still no breakaway gap. Happens. It's going to happen all the time. We're going to find lots of examples like that as well. But look at this one right here. This one you can clearly see has all the conditions met as well, and what forms, right? I'm going to do it quickly. Part of a BPR? Yes. Third candle condition? Yes. Higher time frame structure? Yes, right?
Yep.
Okay, let's do one more and then we'll call it a nice quickie lesson a day, only an hour. This is a really nice BPR in here. Now we're not going to look at this part as refilling it. We're only going to be considering the buy side of the curve here, okay? Which is going to be this part of the curve. Okay? Let's just frame the breakaway gap. Eventually, all breakaway gaps get revisited, as you can see. Don't believe me? Just look at the chart, right? All breakaway gaps get revisited eventually, but whether they get revisited in that current order flow is what we're evaluating. Condition 1, is this part of a BPR? Let's extend this right, and let's just see.
Yeah.
Would you look at that, right? Tiny inefficiency, still an inefficiency, right in there. You see that? Right here. Oh yeah, right here. It's actually a big one. What am I talking about?
Big, it's big.
Big.
Yeah.
Okay. So condition 1 is met. Do you notice how it's never random? Like these conditions I've noticed over hundreds of fair value gaps I've studied. Just looking at what causes a fair value gap. Because for me, it was never enough just to have some gaps never be revisited and some revisited. So like for me, I was curious. So this is stuff that I've seen. So I'm not surprised by that. Okay. So yes, condition 1 is met. What about condition 2? Is there higher time frame structure?
Break or another fair value gap.
Yeah,
Another
there's.
fair value gap. Yeah, right in here.
Yeah.
And then we have a breaker in here. But this breaker is actually not. This breaker is aligned with the fair value gap, so I wouldn't say that. But I would say
Yeah, it's more
that
of
once
an
we put in
order
this,
block.
Oh, if it's aligned with the fair value gap, you don't want to use
yeah,
it.
you're looking for like higher. You're looking for structure that would protect it, right, from being traded into. But look at this.
Oh, okay.
Once we put in this down closed candle, I'm very sure this is going to be a breakaway gap. Why? What do we just print?
Another fair value gap
What's this?
on the northern block.
This will be in our next lecture on what are the best order blocks. You'll notice that order blocks that engage a PD array, like a fair value gap, a time-based one, are going to be the best. Do you see how this is 2 p.m.? New York PM kill zone. This 6 a.m. order block is now going to be the part that's used at 2 p.m. again the next day to go higher. This order block in here is an A+ order block. We'll touch on order blocks next time, but let's just know for now that we have all 3 of our conditions met in here. All right, and yeah, there you go. So that is fair value gaps. Where's my little note? That is fair value gaps and when we expect them to be breakaway gaps. Something that's not taught by ICT really, but you can definitely get a lot of value out of using these confluences. Now, when do we expect FVGs to invert? Let's spend 5 minutes talking about that, and we'll just summate this entire portion by saying we expect a PD array to hold only insofar as the draw on liquidity has not been met. Once the draw is met, we expect PD arrays to invert, i.e. FVG becomes inverse. That's it. So let's find some examples on the 4-hour chart. When do we expect PD arrays to hold? It's a 4-hour fair value gap, right? When do we expect it to invert? Once we print that SMT with ES, the draw on liquidity has been met, and we get an inverse fair value gap. Very simple, because now the program has shifted from a buy program to a sell program. We now expect the same thing of which fair value gap? This one, right? This fair value gap holds. Do you see how this fair value gap holds to deliver price to the draw? You see that? This was the SMT high right here on Monday, right?
Yep.
It holds perfectly. Institutional order flow is bullish. Delivers, then inverts, and then price will come back in and refer to it as potentially, right? Resistance. Let's take a look at some more examples. This one right here. We are on the buy side of the curve. What is the draw on liquidity? This high. It holds until the SMT is printed. We're on the sell side of the curve. Look at the resistance offered by this same institutional level of support. What do you think is going to happen with this fair value gap should we keep trading lower? Right? It'll offer some form of resistance. Let's take a look at some bearish ones to make the same argument. Do we see this fair value gap in here? Does it offer resistance?
Yep.
What is the target?
Until we take the low.
Yep, the draw on liquidity.
Yep.
Once the institutional level has been liquidated, we expect fair value gaps to inverse and offer support. Notice how we print another fair value gap in here? This BPR is signifying an early market structure shift above this high. So Yusuf, you know how you said, well, there is no market structure shift, right?
Yeah.
You see this BPR? Even if I didn't get this market structure shift, I could have anticipated this high would be ran just based on seeing this BPR and this liquidation right here, right?
Yes.
It's all narrative, right?
Um.
This was the draw on liquidity. We don't expect this fair value gap to hold. When it doesn't, we can now market enter this 4-hour candle closing through it and target that high, right? That's an inverse model. Some guy named Dogsy DD teaches that model. I don't really use it that much, but it's interesting nonetheless. Let's take a look at some more inverse fair value gaps. This is a great example right here. Okay. This is a bearish fair value gap, right? Once we've liquidated, and it's actually a breakaway gap, believe it or not, on this side of the curve. Once the draw on liquidity has been met, this low, right? Once we've liquidated this, I'm going to make this different color. Once we've liquidated this...
Quick question. How do you know that was the draw that's going to liquidate it?
Let's look at a higher time frame.
You just went to the daily or...
That's our ERL, right? Our
okay.
IRL.
Oh, yeah. ERL. Okay, got it.
That's
You just
also,
went
that's also
higher
a
time.
4-hour what? ERL, right?
Yeah.
So a higher
ERL.
time frame draw, right? I can also...
Higher time frame,
my
lower
eye
time
just
frame, ERL.
immediately sees this as a market maker model. Right?
Was that on daily fair value gap or weekly?
It was a daily fair value gap.
Alright.
On a weekly, it was a weekly fair value gap as well.
Mm.
But you might be wondering, like, why do I think we're going to stop there? Because my eye immediately, I don't know where your eye goes. My eye goes to these candles right there. Do you see these up close, this up close candle right here?
That breaker?
My eye immediately goes to this breaker. Whoops, I don't know why I did it. Horizontal.
Yeah.
If eventually your eye's going to go just to there. It's not even going to look at this buy and sell side of the curve. You're going to recognize, are we in bullish or bearish order flow? We're in bullish order flow, obviously, right? Are we in bullish or bearish order flow?
Bullish.
Yeah. So
Bullish.
every time I see a sell model, where's my target? It's going to be a swing low on the same time frame, which is going to be a higher time frame gap, right? And then it's going to be this breaker. This is the sell model, right? And then this is the buy model back up, right? So my eye immediately goes to this candle right here. And with time, your eye will go to the breaker too, right there, and be like, this is where we want to reverse and go for long. You can also just say, well, here is the original consolidation low, right? You can draw something like this and be like, this is your market maker model. Right?
Yeah.
But the reason why it stops there is because you have a daily fair value gap in here, and you also have this daily breaker, which you'll see right here. Right?
Yeah.
So price stops dead in its tracks in this daily breaker. In these wicks right here. Or you can see more precisely directly at that 4-hour breaker. Right? So that's the reason why you're anticipating this to be the stop run. Once you get the liquidation, now you're expecting this fair value gap to fail and offer support. So as it does, right? Price trades through it. Then you can see we're accumulating, but you see how this fair value gap is now offering support?
Yeah.
Lower one more time into what? This area, which is going to be the balanced price range of this fair value gap, right? This low risk entry takes it. There's also this fair value gap down here. Rebalances. Again, this is pretty choppy ass price action, but you're not anticipating a short from this fair value gap. You're anticipating this to fail. Then watch. Once we close above this fair value gap, right? You see how this wick comes back in? This immediate rebalance leaves this breakaway gap in here, doesn't it? We just talked about, right?
Because that's buy side and sell side. Yeah.
Yeah, but this is part of this balanced price range, right? It's referring to this inverse.
And then you could enter on that breaker, right?
Yeah. It's referring to this inverse fair value gap, and boom, price rockets higher.
Inverse from like, oh yeah, it's or inverse for yeah.
Yeah, right, or inverse right here. Same exact thing right here. This is a bearish fair value gap that has institutional sponsorship lower until the draw is met. So you can see we come back in, we rebalance. Once we close through it, now it's going to be offered as support. This in here is just a rebalance. It's not shorting, it's rebalancing this area of price. What do you see right here? Same thing, right? Once we close through it, look where price comes back in. Uses it as support, moves higher, right? Because the draw on liquidity has been met. Make sense?
Yeah.
So inverse fair value gaps should be expected when the draw on liquidity has been met and you expect the institutional order flow to switch. Coincidence, right?
Wow.
Comes back in, refers back to this old level of selling is going to be a new level of what?
Buying.
Buying, right?
Old selling,
Yeah.
news level of
Old
buying.
selling, old
Support
selling, new
buying.
buying, right?
Yeah.
Okay, so we have that level, perfect. You can find a lot of them, right? So again, here, this is a institutionally sponsored level of resistance. You can see it. Look at the bodies, right? Price is delivered to the sell side. Look at the bodies hold once we close through it. Do you see that?
Yeah.
Right? And then we go higher. Again, this fair value gap means nothing anymore. Do you expect this fair value gap to hold?
No, because the draw was met.
Yeah, and then look what happens. What's in here? A balanced price range, right? Fair value
Yeah.
gap, fair value gap, or a sharp.
So if that price risk is balanced, why does that? You see the
This?
that candle why does that still? So if the price range is balanced, why does that still work?
Because there's no other inefficiency for it to refer back to. So it needs to come into something.
Okay.
If there's a lower fair value gap, it might lead this to breakaway. Remember our conditions?
Okay.
1, 2, 3?
Yeah.
This one doesn't meet. This one only meets one of them. Is there a BPR? Yes. Right? Is there a lower structure? No. Correct? No lower structure?
Yeah.
And then
This-
is
yeah.
a 3 candle pattern. 1, 2, 3. Well, I don't see this third candle, right? Closing below the second one, do I?
No.
So then this 3 candle pattern doesn't work, does it?
No.
And there's no lower structure. So do you have to see a breakaway gap?
Yeah.
We don't expect it to be.
I mean, you can't.
But I think
Well,
user,
okay.
user
So
is
this
asking
idea
why.
of balance being, so we see the buy side, then we see the sell side,
Yep.
right? On that side,
Yep.
that's like, I thought like that. That means like, can that still be used as a PDA?
Absolutely. It's still a fair value gap.
It's
a
still a
balanced
fair
price
value
range,
gap.
but it's also a SIBI, right?
Yeah, but price has already been efficiently delivered.
You're right, but
No?
price can rebalance an area of previously price can revisit an area of balance, can't it? This is still a SIBI.
Yeah.
This is still a SIBI. But
This is still a SIBI.
if you have lower gaps, right?
Yeah.
Then price doesn't have the same momentum or the same need to come back into this gap, right?
Yeah.
Because this is
No,
more balanced
yeah.
than just a plain SIBI, isn't it? Because it has this entire balance on this side. But using our conditions for breakaway gaps, does it meet any of the conditions besides the BPR? No.
Besides the BPR, no.
Right? Is there any structure lower that would stop price from coming back into it? I don't see any other PDRAs.
No. Yeah.
Right? All I see is bullish PDRAs, like this breaker, right? So I don't see a reason why price wouldn't come lower, right? Or wouldn't come higher. Also, does this third candle displace this, or this third candle displace this second candle's low? Not at all, right?
This can no. Yeah.
And what does that leave right here then?
Another
External range.
inefficiency.
Yeah, external range. Right?
Yeah.
Remember? Now it can target that. What do you think we're going to see here? Is a market maker model on a lower time frame, right?
Another market maker style model.
Yeah, remember coming into the 4-hour gap, we're going to create a buy side of the curve, and this will be the sell side of the curve, and then we're going to liquidate it, right? But when we displace the third candle like we saw earlier, right? Like when we get these breakaway gaps like this, where we displace this second candle rather, right? There's no swing low or high left to target, right? By the fair value gap. So if it comes back in, you can't create a market maker model in there, can you? Because you've already displaced the high.
Yeah. So if it left the high, right? Let's say displace the high. The third candle displaces the second
This
candle's
candle,
high.
you mean the low?
And there's still a. I'm sorry.
You mean this candle?
Or yeah, the low or the high, like
Yep.
depending on which side it is. If it left us, like it can, like let's say price makes another swing low, then it could still trade into it, right? Then if that swing low is left there as like stops.
Yeah,
But it's still one of those
absolutely, right. I'll do this and target that low.
Okay.
But it just doesn't need to refer back to this fair value gap in all cases, right? Because it's already displacing lower, maybe creating another gap. which then it's going to use for what? That buy and sell side of the curve, right? Market maker model.
Next sell side. Yeah.
Right?
Next sell
Every retrace is a market maker model. Remember, look at this right here. This in here is your market maker model, right? So we're coming in, we're leaving the swing low, right? Look at the pattern, remember? 1, 2, 3. Does this candle displace this candle low?
No, it
No,
doesn't.
so what does
it's
it
gonna
leave?
trade back.
It leaves sell side.
Yeah.
So then we come back up.
Oh, so then you can target that leg.
Yeah,
again.
then you
Okay,
well,
got
that
it.
is your low. That is your draw on liquidity, right? This is just
That's the
extra.
OG consolidation
That is
of
the
the
OG
15-minute
consolidation.
model.
By definition, this is where you're consolidating before moving higher. Look at it on a lower time frame.
Yeah.
Fuck, I went way far back, but let me find it. What? Did anyone remember what day that was?
Do you have an indicator with for SMTs?
I do.
What is it
It's
called?
It's by TIFO. Fuck. I don't know where I put that. No. Where did I put it? Oh, right here. I have to prove this to myself now. Right? So right in here, Yusuf, is our original consolidation, right? You see it.
Yeah.
We left the sell side, right?
Correct.
And then we come back into the fair value gap. That's the market maker model, right?
Yeah.
And then what do you think we're leaving on the buy side? Market maker model, right?
Yeah. So
The market just
can
moves
you
like
go to
this.
can you go back to the 4-hour again?
Yep.
So this is now, but okay, a buy model into that 4-hour fair value. So same thing again, basically.
15-minute buy model into the 4-hour fair value gap.
Okay, because that third candle that we had today, or at least today, I think that's still the
Third candle
Thursday's
left
candle.
the left sell side.
Yeah.
Left
So okay, so now it's
One,
basically happening again
two.
with Thursday's candle. Like the Thursday candle just opened at 6 p.m. Right, but
Where are you looking?
right. Today
Oh, today.
or today. Oh, that's back. Sorry,
It's way
sorry.
back. It's way back. Yeah. So
I'm so
here's-
sorry. I'm so
here's an
sorry.
example.
Yeah, I
So
made
here's
you
an
go.
example of
Oh
breakaway
shit!
gap.
I thought that was
Do
today.
you see how we don't need to come back into this 4-hour gap? Look.
Yeah, that one makes sense. The one before
Look,
that.
let's actually
makes
use this
sense, too.
live, like on today's
We hit
price
that
action,
beyond.
right? Condition 1 is met, right? BPR.
Yeah.
Condition 2, which is gonna be lower structure. Yeah. See a shit ton of lower structure.
Yeah.
There's like 5 PD arrays in here, right?
Uh-huh.
Okay, fantastic. I don't need to come back into this one at all. And also, we didn't leave sell side to come and target, right? 1, 2, 3. The low is now here. So now, if we're going to come back all the way up into here, this would be the market maker model. But usually, if this candle fails to displace, you're going to leave sell side there, come back in, and then attack it. The sell side's all the way down here now, right? There's no coming back into here. Now we have to come all the way back down. This is a deep retracement now, right? Whereas if you don't close that third candle below the second, you're leaving sell side, which then you target in this market maker model. Right?
Yeah.
Like, look at this, for example. Let's look at another 4-hour fair gap. Like, it just gets regularly balanced. Okay. Do you see how we're leaving sell side right here? 1,
Yeah.
2, 3. What do you think price is gonna do? It's gonna create a whole buy model to target that high.
Can you go to the 15 on that
Yeah.
now, so I can just see it?
Yep. Right?
Yeah, that is really fucking. God, that's so clean.
Right? Because you're leaving sell side. You're not displacing, because otherwise you're just displacing through this area, putting in more structure. Right? But you're not displaced through, you're leaving ERL. ERL to IRL to ERL, right? We come back in. Keep going, right? It's all the same. So the only benefit I'm telling you about that third 3 candle patterns is essentially telling you when liquidity is being taken versus generated. Make sense? You're generating liquidity right here. You're not generating it if you close through it, right?
Yeah.
So look,
Yeah.
do you see how all of these candle, like this candle right here, right? This high is leaving a high, right?
Yeah.
That's gonna be the target for this entire retracement lower. This high, this external range high, right? So you look at that in the context of fair value gaps and retracements. Like for example, here's a fair value gap. Let's say regular fair value gap. Do you see how we have 1, 2, 3? This leaves the external range, right? Intact, full external range, right there. ERL. ERL goes to what?
IRL.
IRL goes
That's
to what?
ERL.
So what does it look like on the 15? You're gonna see it.
Swing market make a buy model. Fuck. Yep.
That's the target.
Yep.
That's the draw on liquidity. So then we come into the 15. We come from 4 hour into 15. When do we get our market structure shift? Above this high.
We get it above that high,
Right.
and then that's a breakaway gap.
Gets tagged here, right? But you see how we leave this failure swing here?
Yep.
Now this has how many conditions at the breakaway gap? Only one, right? It's not part of a BPR.
Does it have two or one?
Well, it has the higher structure. It's not part of a BPR, and then let's see 1, 2. Oh yeah, it has 2 conditions. Yeah.
It has 2, yeah, but I guess that's not an A+, so then it'll trade back into it.
We leave it as a breakaway gap, right? We leave it as a breakaway gap. We still leave it as a breakaway gap for over 40 points in the Asian section, right?
Yeah.
And breakaway gaps are always returned back to. So we come back into it. When would it be our entry? Let's see our kill zone entry. So we now got our 15-minute market structure shift. We're gonna wait for a kill zone to open. Let's see if we can put our kill zones on. Okay. So we're gonna wait for New York. There we go. We get New York tagging this 15-minute gap, right? So look at the 4-hour chart again. Essentially, we get New York. We get this 4-hour reaction, and then New York comes back into this 4-hour breaker, or order block rather, or the 15-minute fair value gap. Doesn't matter. You want to use your intermediate time frame now, right? Because remember, once you're looking at the 4-hour market maker model, you're going to be using your intermediate time frame for structure, right? So 4-hour PD array, 15-minute structure. Okay, so here's the 4-hour PD array, 15-minute structure.
Do you have to wait for structure here because it ran those lows and it probably had an SMT there? Like, is it just? I mean, the one before that.
Right here.
I see that one. The old one. The first breakaway gap.
Here.
That one. You have to wait. Like, can you enter on that lower one?
Well, you wouldn't enter a 7:45 p.m. anyways.
Oh, that's right.
So you
okay.
wait for a kill zone, right? So all you're doing is you're waiting. Like
That
4-hour tagged.
Yep.
This is the order pairing. Order pairing on a lower time frame looks like 2 candles that have bodies that overlap, right? On a higher time frame, this is going to be that wick. Then you get that market structure shift right here. Once you get your market structure shift, then you want to go in, wait for your kill zone again. London protraction, right? And then right into this is your low risk entry right here, right? This is your LRE.
That's the LRE.
This happened. This gets tagged right before. Whoops, it's not an IFVG. It's an LRE. Happens right before the kill zone opens. Then we get our market structure shift right above this high. Where is it? Right here. And then you can trade this distribution higher. So again, this is the low-hanging fruit. If you want, you could take something earlier, like an inverse fair value gap entry, right? Something like this, a BPR entry. See that?
Yeah.
Like that's like super clean, right? But if you want to wait for structure, right, then you have to wait for a market structure shift, which wouldn't be until this high is closed. This high is closed, which is the same thing as this high being closed. So once you close this high, and once you close this high, you can now wait for this fair value gap, and then go long in here, and just target this swing high. And then you want to stop loss below here. It's a 2-hour trade, right? You can also use some deviation projections and see what's a symmetric move of this run. Target 2.5 if you want.
-3, right to -3.
Yeah, I would just target that. Right. Yeah, so.
This is so easy to see in fucking hindsight.
Yeah, of course. That's why you have to do it in hindsight enough times so that you can start seeing it in real time. Like look how easy the past few days have been in hindsight, right? So you're using the daily model, right? Or the 4-hour model, let's say, okay? So you're using the 4-hour model, so you're waiting for a 4-hour PD array. You got the SMT, nothing here, nothing here. Okay, today. 4-hour liquidity void, right? Or fair value gap, whatever you want, whatever one you want to use. I'll just use liquidity void, for example. 15-minute structure, right? So when do we print that? This is overnight, right? When's the first time we take? Yeah. Okay, 15-minute structure. London kill zone, right? Market structure shift. Where is the low risk entry now?
The lower entry is that fair value gap.
LRE. New York opens, right? Where is it? Where do you get your entry?
Yeah.
Right here, and then you go down to the 1 minute, right? 4:15:1, right? So here's your 4-hour PD array in here. Let's make this red. That's your 4-hour PD array, which is your volume imbalance on the 4-hour chart. Once you get the 15-minute market structure out of here, you wait for us to come back into this 15-minute gap. Then you look for a 1-minute entry because structure is going to save you.
So my question for the 15-minute gap that it trades back into.
Yeah.
Technically, didn't that meet all the criteria for a breakaway? Okay, but I guess a break you could still just trade back into it.
You can still trade back into it, but I don't see like meaningful structure below here. I see this breaker right here. We didn't put in structure below here, right? We just put in another gap. Structure means like this. Structure looks like this. Right? Like we put in another breaker and a fair value gap. You see that? Like this is like meaningful structure in here that we'll refer back to go lower. This is just like 2 consecutive fair value gaps, right? But even if you look at the conditions, right? Is this part of a BPR? No. Right?
No.
Does it meet the 3-candle rule? Yes. Is there lower time frame structure? Yes, but it's just another fair value gap. There's no meaningful swings, right? Notice how we don't put in another swing low? We put in no other swing lows, right? It's just liquidity sweep, right?
Yeah.
So it's not meaningful structure to me, is it? Like, is anything stopping price from coming back in here besides this one fair value gap, which is in discount, not premium, right?
Okay, yeah, there's that too. Yeah, no then.
So it's not an A+ setup. Also, you have New York open, which is going to manipulate higher. Where's our news? Where the fuck's our news fucking... Here we have our news, which manipulates 15-minute gap. Then we wait for 1-minute structure. Right, so we're just chilling. We're in the 15-minute gap. This is our low risk entry. Do we get a market structure shift? Yeah, this is a pretty shitty one. I wouldn't take it because we have news coming out at 8:30. I don't want us to close below here. So wait for a real market structure shift with displacement. Nothing. News comes out, manipulates the high. No structure put in. Boom. There we go. This is structure shift to me. Below this low and below this low, right? Remember about our lesson on different types of structure, intermediate, short-term, long-term? This is the low that puts in this high, right?
Yeah.
Break all the structure. Now what's the low risk entry? Well, the low risk entry is going to be this imbalance right here. Cool. Enter somewhere in here. You have to sit through some wick. Doesn't matter. The wick doesn't mean anything. Right? You can chop yourself up because of the wick, or you can just recognize that this PD array is good. This one's good as well. I would use this one because it's the highest one in premium. So enter there. Right? Stop loss has to be what? Invalidation of this PD array, right? Or closure above this high. So you sit through this random wick, whatever, fuck the wick, who cares? And what's your target? Well, 15, yeah, go to the 50-minute, right? The retrace is going to be your target.
Yeah.
So actually, the 1-minute retrace is your low-hanging fruit, which you can clearly see is right here, right? That's your low-hanging fruit. And then your intermediate target is going to be based on your intermediate structure, which is going to be all the way down here. There you go. And you can also use your deviation projections on your lower time frame to find a target. There you go. Right? It's a beautiful trade. This was the only trade that actually that made a lot of fucking sense today. It was just a perfect sell-off. And then yeah. In the afternoon, the same thing. If you're using the same model, right? You're still bearish.
Yeah.
Okay, so you're waiting in the afternoon. Again, come back into this 4-hour gap. Go to the 15-minute. Wait for the market structure shift. Come back into here. Right there. Structure shift's going to be below this low. And the entry you wouldn't have gotten because there is none, but you can maybe take this fair value.
There's no interest.
Yeah, I guess for FOMC it might have been better to use the hourly model, right? Because you create this new
Yeah.
hourly gap. Hourly gap. Right? And then even here, 5-minute, all you can really get is this piece right here. Which is still 100 points. Holy shit. That's volatility.
That's huge.
Yeah, it's volatility.
Fuck. God damn.
But yeah, this was like kind of a bitch to navigate because I thought that we were gonna get the distribution here, but then I forgot that like 230 usually causes another fucking run up. Like this is just like manip, and then deliver, right? Manipulation lower, manipulation higher, and then deliver against all of that.
Yep.
But yeah. Oh shit, unless it's still required.